Well, continuing our corporate finance journey, having covered corporate governance and capital budgeting, we're going to turn our attention now to the cost of capital. When we've been talking about a discount rate, we've kind of interchangeably used that with the cost of capital. The idea of a corporation being raise capital at 7% and invested in assets in an organization that generates a return on that greater than 7%, and that's what creates value for shareholders and company growth. And so we're going to look at our cost of capital, our different sources of capital, and we're going to put those together to give us what we call a weighted average cost of capital, which is going to be the average across all our capital sources, so we get an overall cost of capital for the organization. So here's the official definition here: the overall opportunity cost of the firm's capital, a weighted average of the opportunity cost of capital from these three sources: debt, preferred equity, and common equity. And back to what we looked at in our decision rules for NPV, projects should be undertaken only if the return on invested capital, that IRR, is greater than its opportunity cost. So here's some of the notation we'll be using. K is our required rate of return, because I think that was initially used by someone who wrote some articles or an influential textbook some years back. So it's not I, it's not R, but these are rates of return. And KD is just the yield to maturity on existing debt or brand new debt, newly issued debt. And KD is the before tax cost of debt, but because the interest costs on debt are tax deductible, we do have some tax savings from using debt compared to other sources of capital. So we want to use the after-tax cost of debt. Remember, our estimated cash flows for these capital projects are all after-tax dollars, after-tax cash flows. And so, as I mentioned earlier on, we need to discount these at our after-tax cost of capital. Well, this is only going to change the required rate of return on debt. So we take the market required rate of return, multiply it by 1 minus the marginal tax rate here in order to get our after-tax cost of debt financing. And then our other notation here is the cost of preferred stock and the cost of common equity. Well, they don't involve any tax deductible payments. Dividend payments are not tax deductible, and so there's no adjustment. We take these to be the after-tax costs of preferred equity and common equity. And so here we are with the weights. Our weights are going to be the percentage of our total capital that we've raised from each of these three sources. So we've got the weight in debt, the weight in preferred stock, and the weight in common equity, times their after-tax required rate of returns, which we've also referred to here as their opportunity costs. So as an example, consider a firm with a capital structure that's 10% preferred stock, 45% debt, and 45% common equity. And then we're given this required rate of return on newly issued debt, or the yield to maturity on their debt as it's trading in the market currently. And then our tax rate for adjustment, we've got a 9% cost of preferred stock and an 11.5% cost of common equity. And remember that these typically line up this way because debt is the most secured in terms of if they're going to get paid. Next in line in terms of priority is payments to preferred stockholders. And last in line, the residual after the other sources of capital are paid, is this return on common equity. And so that has to be a little higher because it's riskier. It has more uncertainty about the future cash flows it's going to produce. And so our WACC, or weighted average cost of capital here, is simply the weight times the after-tax cost of debt here, the weight in preferred stock times the cost of preferred, and the weight in common equity times the required return on that common equity. So for firm X here, we get a weighted average cost of capital of 8.1%. And in a lot of applications, that's what we'll use as our discount rate in calculating the net present value. The target or optimal capital structure refers to the proportions of debt, preferred stock, and equity that the firm is aiming for over time. And it's suggested that analysts should use this target capital structure when it's known in calculating the weighted average cost of capital. So how do analysts determine these weights? Well, one way is just look at their current capital structure weights and assume that they're where they want to be. Okay. Now, if there's trends, sometimes a firm will be paying down debt, okay, over time. So debt's getting smaller, common equity's getting bigger. So one thing to do would be to take the existing weights and then adjust them for these trends and say, well, this is where the firm is heading. Another thing we can do is that even though there's variations at points in time over the proportions from the different sources of capital, we can use industry average weights and just assume that, well, on average, that's where they're headed and that's where they're going to be over time. Now, we have the weighted average cost, but we have this other term here, marginal cost of capital. Well, we know from our economics that when we say marginal cost, we're talking about the cost of an additional dollar. Here, an additional dollar of capital. So it's really the weighted average cost of raising an additional dollar of capital that we're going to refer to as our marginal cost of capital. And the assumption is that this firm's marginal cost of capital increases as the firm increases the amount of capital it raises. So if they issue more debt, maybe their cost of debt goes up a little bit. If they issue more common stock, perhaps that can only be sold at a lower price if they're issuing more of it. So that's going to increase the required return on that. So it's these increases as we raise greater amounts of capital that mean this marginal cost of capital increases. And remember, when we say marginal cost of capital, we're talking about the weighted average cost of capital, but now we're talking about how it changes as we raise greater and greater amounts of capital. But our assumption is this is upward sloping, and this leads to a result where we can talk about the optimal capital budget. And here it is now, the optimal capital budget. So given these expected returns on the potential projects, we could order these projects from the project with the highest internal rate of return to the project under consideration with the lowest internal rate of return. And that downward sloping curve we're going to call the investment opportunity schedule. Downward sloping as the total capital budget gets larger and larger. And the intersection of this investment opportunity schedule with our upward sloping marginal cost of capital curve, which is increasing as our capital budget increases, that intersection, we get a point we can identify as the optimal capital budget. That capital budget that will maximize the value of the firm. And here we've plotted it out. Here's our internal rate of return rankings up here. So here's our investment opportunity schedule, decreasing IRRs as we increase our capital budget, and our upward sloping marginal cost of capital. And where they intersect, we call this the optimal. Because look, for this project over here, remember on the investment opportunity schedule, these projects are ordered by their decreasing internal rates of return. And here's our weighted average cost of capital at this amount of capital budget. Well, at that point, our IRR is greater than our weighted average cost of capital. So that's a positive NPV project. And they are all positive NPV projects until we get right here. That project there would have a net present value of 0. The cost of capital and the internal rate of return are just equal. Now, beyond that, if our capital budget, considering projects out here, Well, now our cost of capital is greater than our internal rate of return. So those would be decreasing the value of the firm. They'd be negative net present value firms. So by coming up with an upward sloping marginal cost of capital schedule and a downward sloping investment opportunity schedule, we can identify this optimal capital budget that's going to maximize the value of the firm, at least based on our expectations. So, some summary here. The WACC is the appropriate discount rate for projects that has the same level of risk as the firm's existing projects. Well, this is because the firm as it exists right now, their costs of capital are based on the riskiness of the firm's cash flows and the uncertainty of the cash flows to these various sorts of capital. So the overall risk of the firm is important in determining what these costs are. So for the average project, that's fine, the average risk project. But say we're looking at a project that has greater than average risk, one of these expansion projects that we think has more risk, more uncertainty than the cash flows from our current projects. Well, in this case, we'd like to use a discount rate that's greater than the firm's existing WACC because the project has greater risk. Now, maybe a pollution control, an environmental project, and one of these mandatory projects we talked about, that might have below average risk in the sense that the cash flows, if we do it or don't do it, are fairly certain, so much less risk. In that case, we'd like to use a discount rate that's less than the firm's weighted average cost of capital. If we used the firm's weighted average cost of capital, which we think is too high for this project, we'd end up rejecting projects that actually have a positive net present value. So we make these adjustments to avoid those biases. So now let's look at our component costs of capital, beginning with the cost of debt. Well, this we've seen, it's dead simple. Here is the pre-tax cost of debt, the current market yield to maturity, what the market requires in terms of returns on their debt, and then we adjust that, multiplying by 1 minus the marginal tax rate to get our after-tax cost of debt. As a numerical example, consider a firm that can issue new par debt, that means debt at its face value, at an interest rate of 7.5%. So that's the required pre-tax required rate of return on their debt. So if the firm has a marginal tax rate of 40%, what's their after-tax cost of debt? Well, clearly it's 7.5 times 0.6, 1 minus that marginal tax rate. So our after-tax cost of debt is lower. It's 4.5%. So when it's available, we want to use the market rate of interest. We want the current market rate, not the cost, not when the debt was issued, but what it is right now, because interest rates, required rates of return change over time. Now, what if the firm's debt isn't publicly traded, so we can't go out and get a price and calculate the current yield to maturity based on the pricing of the debt? Well, one way to do this is to estimate the yield to maturity using, well, it's kind of a fancy name, right? Debt rating and maturity of existing debt. Well, the idea of that is to say, well, this firm's debt doesn't trade, but its investment, rating is single A. So we go, well, okay, their debt outstanding has an average maturity of 12 years. Let's just go and see in the marketplace what firms with single A credit are paying on their debt and use that because we don't have the public trading information. Now, for firms that use floating rate debt, see, rather than issue a 10-year bond, the firm may issue bonds that pay the 1-year rate of interest and then it resets every year. That's what we mean by floating rate debt. We let the interest rate on the debt change from period to period, whereas if we issue 8% bonds for 10 years, we refer to that as fixed rate debt rather than floating rate debt. But the suggestion here is, and you might want to think about it this way, that in the marketplace there's two ways to raise money for 10 years. We can either issue a bond that pays the current market one-year rate of interest each year for 10 years, or we select a fixed rate and pay that rate every year for 10 years. Well, given that there's arbitrage opportunities in the markets, these should be pretty close to each other. So the suggestion here for firms that use floating rate debt is we'll estimate the cost of debt using the yield curve. So we'll look at the yield curve for fixed rate debt for a firm with a AA minus rating. And then if it's 10 years is what we're looking at, then we look at the required rate of return on 10-year fixed rate debt and use that rather than the actual floating rate that the firm's paying in the current year. The cost of preferred stock, well, we saw before how to calculate the present value of a perpetuity, and this is really just a little bit of a twist on that. And we say the required rate of return on the preferred stock is simply its dividend over the current market price, because the dividend doesn't change on preferred stock. It's typically set for the life of the issue, and that life may be perpetual. So the returns you're going to get are going to be basically that interest rate, what you paid for a preferred stock in the denominator, and the preferred dividends you're going to receive on an annual basis in the numerator. So as an example of this calculation, if we've got a new non-callable, meaning it can't be called in, non-convertible, it doesn't convert into common stock, preferred stock, and so we assume it has no maturity, but pays a dividend that is $8.50 each year, and we see in the marketplace that each preferred share is priced at $100. So what's the firm's cost of preferred stock? Well, it's simply $8.50 over 100, or 8.5%. And again, there's no tax adjustment here because there's no tax benefits. There's no tax deductibility of the payment of preferred dividends. So now let's take a look at the cost of common equity. This is a little more complicated than what we've seen because we've got three different methods here. And the first one is the capital asset pricing model, that if you ever had a beginning finance class, you've seen this. And the capital asset pricing model, which we cover in some detail in the portfolio management topic area, just says the required rate of return on the common stock is the risk-free rate plus this beta times what's in these brackets here is the market risk premium. It's the extra return over and above the risk-free rate, because we can earn the risk-free rate if we just don't take on any risk. So the excess of the expected return over the risk-free rate, that's what we're getting for taking on risk. And beta here is our measure of systematic risk. And so for each unit of beta, we get one market risk premium. So let's put some numbers to this and make it at least useful to us now, although I say we'll learn more about it in another section of the curriculum. So our example here, we've got a Treasury bill rate of 5%. We're going to take that to be our risk-free rate. Our expected return on the market is 11%. So our market risk premium is just the difference there, 6% for each unit of beta risk, because beta is scaled into units of market risk. So if on the market portfolio we get an extra return, a premium of 6%, well, this firm has 1.1 units of that. It has 10% more risk than the market portfolio. So we get 1.1 market risk premiums. 1.1 times that 6 there is 6.6. Add the 5 and get 11.6. So that's one way we might calculate the required rate of return on common stock. And so, as you can see, this is a little more involved than what we're looking at for debt or preferred stock, which were pretty straightforward, especially if we have market prices. The second method is the dividend discount approach. And I can give you some intuition about this. If you buy common stock, there's two ways to make money. You can collect dividends, and the price may go up. And so those are the expected returns on common stock. And so that's all we've got here with this dividend discount approach. This is the yield, current price of the shares in the denominator, and the annual dividend, the current annual dividend, or the dividend expected over the next period. That's why we've got it subscripted D1 there. And so that's your dividend yield over the next year. And G is the growth rate of the firm. So we assume that the price of the stock will go up by G each year, at least on average. That's the expectation. One way to calculate this G, okay, is the return on equity times the retention rate. Now, the retention rate, sometimes we say that's 1 minus the payout ratio. And the payout ratio is the percentage of earnings that are paid out as dividends. So 1 minus that is the percentage of earnings that are reinvested in the firm. So that's where we come up with this constant growth rate. It's the rate the firm could grow just based on its own reinvestment of earnings, the retained earnings. So let's look at some numbers for this method. Firm X's stock price is 21. Next year's expected dividend is 1. ROE is 12, and the dividend payout ratio is 40. Well, we can get the retention rate from 1 minus that. Our retention rate is going to be 0.6. Our dividend yield is simply 1 over 21. And we can get our, well, let's look at these numbers here. We've got 7.2% here. And here's our dividend yield, and here's our growth rate. Well, where did we get our growth rate? Well, we take 1 minus 0.4. That gives us our 0.6 retention ratio times the ROE of 12%, so 0.6 times 12%, and that's where we get our 7.2% here as our assumed constant growth rate over time of G, sometimes called the sustainable growth rate. And our third method for estimating the cost of common equity is probably the easiest of the three. And when we don't have the stock trading publicly, we can't estimate its beta, we can use this. It's a little bit of an ad hoc, somewhat arbitrary approach. But the idea is, well, the stock's riskier than the bonds. So if we've got bonds trading, or we can estimate our cost of debt from whatever sources, then we can just add a premium to that, an equity risk premium to that. And that equity risk premium that's used is usually between 3 and 5%. So there's some judgment in picking which of that to use, and this is imprecise. But it's imprecise, but you can't go that far wrong. Okay? We may be a little under, we may be a little over, but we're not going to get really misleading results with this bond yield plus some somewhat arbitrary risk premium approach to estimating the required rate of return on common equity.